Consumer prices in America rose 4.2% in April, marking the largest 12-month growth since 2008. From groceries and furniture to used cars and airplane tickets, prices in the United States have shot up beyond expected levels, and some are now worried that inflation will continue at an uncontrollable pace while wage levels stay where they are. At the same time, job figures have been underwhelming. Fewer people have been returning to the workforce, even though businesses are now ready to reopen. Today, we discuss what's going on in the world's largest economy and what the worrying numbers might mean for South Korea. For this, we connect with Dr. Jinill, Professor of Economics at Korea University here in Seoul. We also have Dr. Micah, POLLAK, Professor of Economics at Indiana University Northwest. Thank you both so much for joining us this morning. And, well, let's begin with you, Dr. Kim. Now, markets in the US and around the world had already expected a rise in inflation in the US before it released its consumer price index. But what's the reason behind such a steep inflation, and why has this been such a cause of concern?
So before the release of 4.2%, as you mentioned at the start, of the CPI inflation over the last 12 months, I think markets were expecting around, as a median, about like 3.6%. So the number was higher by 0.6% than expected. So people were expecting inflation. It's much higher than expected originally. And as expected, if you remember a year ago, the energy price, or as a future, sometimes it's a negative range. So very low price level because of the COVID around the world. But now, since then, 12 months have passed, and a lot of activities have been going on. And that's why we got such a high number in the inflation side.
Right, so some are saying that as the economy reopens, we are seeing prices sort of react to that by leaping beyond expected levels. But Dr. Kim, the Fed, they said that this price surge is going to be quite temporary and it's going to eventually balance out. But some prominent economists like Larry Summers, they've long warned that Mr. Biden's $1.9 billion stimulus plan, it could actually overheat the US economy and increase the inflation risk. What's your opinion on this? And do you think this recent inflation trend is just a phase, or do you think it's going to be more enduring?
It's hard to tell at this point. Like, if you go back to the global financial crisis, at that time, Fed balance sheet almost quadrupled, like 4 times then before the 2008 global financial crisis. So in that sense, the money expansion or liquidity expansion was huge, but we didn't see inflation at that time. And then your question is what's about now? Now the Fed balance sheet has expanded again to another record level, but we haven't seen inflation up to a few months ago or several months ago. And what about this 4.2%? Is it persistent or not? And as you said, many Fed members, including the vice chair, Richard Clarida, that made a speech just after the CPI announcement that these movements will be or would be transitory. That's why they are not starting what they call tapering, or they start thinking about tapering. Maybe they thought about tapering, but they don't say tapering is imminent. And the question is whether the price will keep rising. As you mentioned, Larry Summers or Olivier Blanchard, they have argued for a persistent rise or warned of a persistent rise in inflation. But others, including the Fed members, are thinking that this inflation will be transitory. So we should think about case by case. For example, one of the big surprise of the last week's announced the CPI release was on the sector of used car and trucks. And relative to a year ago, it rose more than 20%. And even relative to a month ago. So March to April increase of the price level for used cars and trucks is about 10%. That's huge. And why? Is that persistent or not? And that's what they are analyzing. And then the people like Summers have a different view than the people at the Federal Reserve. And it's kind of too early to tell And people are thinking of July and August. That's when we will see which side is correct, because economy was so much under pressure in March and April around the world. But by last July or August, it was coming back slightly. So let's compare this coming July or August against last July or August. And that's we'll see which side is correct.
Now, Dr. Pollak, good evening to you in Indiana. Well, I want to hear your thoughts on this. And there's also been concern that, further inflation, it's probably going to outpace gains in wages and leave consumers struggling to meet ends. Do you share this concern?
I actually don't agree and share that concern. I think that many families have been struggling during this last year to make ends meet, and the stimulus package brought much of that needed relief. And so during a global pandemic, I think it's more responsible to directly help those that are struggling now, rather than delay or deny that help over the possibility of inflation coming down the road. And I don't necessarily believe that we're seeing clear evidence of sustained inflation yet. In April, we did see the largest increase in the price level, in some time, but this was mostly an artifact of prices being so depressed exactly 1 year ago as the U.S. entered lockdown. And in fact, more than half of this increase in the price level was due to energy prices. And not because they've necessarily risen, especially recently, but because, as Dr. Kim said, they dropped dramatically exactly 1 year ago. And if we do start to experience significant and sustained inflation, we've held interest rates at record lows for a long time and have been doing extensive quantitative easing. And I think we have plenty of room to ease off the accelerator as the economy picks up, if that does indeed turn out to be necessary.
And Dr. Pollak, now the Labour Department, meanwhile, it's reported last week that US employers, they added 266,000 new jobs in April. And that was far less than the estimates by economists. They were predicting around 1 million new jobs. And the unemployment rate too, so that was little changed at 6.1%. Some say that the COVID-19 stimulus measures are actually incentivizing people to pass up job opportunities. Would you agree with that?
Yes, I hear that a lot, and I agree, but only in part. I think what we're seeing is that people are being incentivized to pass up poor quality job opportunities. So those that don't pay a living wage or provide basic benefits. Stimulus measures such as expanded and extended unemployment insurance have been shown in the past to generally allow workers to remain in the labor force longer and continue to look for a job rather than causing them to drop out. Ultimately, workers want careers with long-term stable income, not a short-term free handout. Put another way, if you believe that a couple of $100s a week is enough to convince a worker not to work for your firm, then you really need to question the pay and the type of work environment your firm is providing. What I think we are seeing in the United States is a great reassessment of work in America. The pandemic has led to workers questioning the value of jobs that maybe pay poorly or provide limited benefits and put them at risk. And I think in some ways the pandemic has created an opportunity to empower workers to retake control over why, when, and how they choose to work. And so I think we're seeing that playing out more than anything else.
Right, so it's really as you said, the poor quality jobs that workers are turning down. And perhaps in response to that, companies that have been facing labour shortages, Dr. Pollak, they're offering bonuses and even higher starting salaries to attract new employees. But the question, though, is this trend going to last? What are your thoughts on this?
Yes, I think so. I think that the market forces that are driving up wages will continue as workers reassess what they value most from a job. But it goes beyond just wages. I mean, this last year, many families faced exceptional demands in their lives outside of work, everything from children needing to quarantine or attend school from home to having to care for sick family members. And for many, this has shifted their priorities. Wages are always going to be an important factor for workers, but to keep workers in the labor force, non-wage benefits like flexible working hours, the ability to work remotely or childcare benefits, paid sick and family leave, quality of health care, safety of the work environment have all become much more important than ever before. And in addition, we're seeing increased hiring competition from the gig economy, where delivering groceries or food allows a worker to have flexibility over when and how they work, as well as direct control over their level of personal safety. These things have become more important to workers, and to attract new workers, it's not enough simply to offer higher wages, but firms need to recognize how the pandemic has shifted what workers want in a job and respond accordingly.
And of course, America, being the world's largest economy, it is being observed very closely by economies around the world. And especially here in Korea, Dr. Kim, a lot of people are interested in the Federal Reserve's rate hike, the pace of its rate hike. And well, the question here is, the concern here is what the Fed is going to do if its prediction turns out to be wrong and inflation does stay too high. And also, Dr. Kim, what would a rise in interest rates by the US Fed mean for South Korea?
Yeah, so the interest rate rise, interest rate meaning the policy rate by the Federal Reserve, which is called the federal funds rate. I think we are still a little bit far away from the increase of the federal funds rate. However, if they turn out to be wrong, I mean, if the inflation turns out to be more persistent than they are thinking right now, and then they will start thinking about tapering, or they'll start tapering. And tapering is like not turning off the supply of money, but they are lowering the speed of the supply of money. So which means that the US will have less demand too around the world, including Korea. So that lower demand was one feature that would influence Korean economy. But what's more important is the rise of the interest rates, not only the federal funds rate, which is 1 day short-term rate, but also a lot of medium and long-term rates, like 5-year rate or 10-year rates, or even the rates for the corporate bond. If they rise, then money will flow to the US economy from around the world. From where? We don't know. That's the future of money. And if that source country turns out to be Korea or any country, that country would be in trouble because of the size, as the Soo-young, you mentioned in the question. So that's why Korea worries so much. And also Korea has a trauma, or the memory of 1997 and 8. Actually, I was at the Federal Reserve Board at that time, so my memory was not exactly aligned with the memory of the country. But anyway, so that memory is a trauma for Korea. That's why Korean economy, or Korean economists, Koreans are worrying so much about the increase of the interest rates of the United States. And on that side, any country, including Korea, should be wary of the movement of the flow of the capital across
Right,
the
especially
world.
during this pandemic time, lots of countries worrying about rising levels of debt as well. And Dr. Kim, in South Korea, our consumer prices also shot up. It was up by 2.3% in April, which was the largest increase in almost 4 years. And there's also been higher prices of raw materials. So there's been a lot of concern about inflationary pressure. What are your thoughts on this?
So as you mentioned, it's 2.3%, which is not as high as in the United States, which is like 4.2%, but it's relatively high. Actually, Korean economy did not achieve, or the Korean inflation of the Korean economy was too low for a while. So 2.3 might be viewed as healthy by some. But if it's higher than their target of 2% for quite a long time, then that's also a risk on the other side to the Korean economy. So the question is the same for the Fed and the Korean authorities, meaning the Bank of Korea. So whether this 2.43% rise or 4% rise, if that's persistent or not, that's the part like Korean economists are curious about. And if that turns out to be persistent, it depends a lot on the Korean vaccination, the vaccination around the world. And as Professor POLLAK mentioned, it depends a lot on the labor market, because the wages are the key in understanding the inflation dynamics.
Right, and I want to ask Dr. Pollak about, wages really. What adjustments or developments you hope to see in the labour market in the US this year for a strong recovery from COVID-19?
Absolutely. So I think over the next 6 months to a year, as vaccination becomes more widespread, we will probably see the labor market returning closer to something we might call normal. But I think at the same time, we will also see some significant long-term changes because of this reassessment of work in America. In many ways, the pandemic disrupted the American idea of what work looks like as workers and firms really search for ways to experiment in order to survive. And while some of these disruptions will probably fade away, others will probably persist. And so I expect that we will see an increased acceptance of more flexible working schedules, as well as working remote options, and then increased importance of non-wage benefits such as paid sick leave, childcare benefits, and also quality of healthcare. And so I think that rather than potentially blaming the workers for the hiring woes, the firms that are able to recognize and embrace these changes in the labor market will be those that are most likely to attract and keep these skilled workers and ultimately be successful in the coming years as the economy recovers.
Right, well, this is where we're going to have to end our interview today, but that was Dr. Jinill, Professor of Economics at Korea University, and Dr. Micah POLLAK, Professor of Economics at Indiana University Northwest. Thank you both so much for your insights today.
Thank you.
Thank you.
And to our viewers, as always, thank you very much for watching.